So last class, we ended up just kind of introducing the financial statements for this company. And this was the income statement we looked at. And then we took a look at the balance sheet. And the balance sheet has other information on it, like price per share. Usually price per share you would get on a stock quote for a company. And we also included shares outstanding on here. Usually that would also come along when you get a stock quote on a company. You can look up summary information, and I'll show you where you can get that on Yahoo Finance as well. And then I also included depreciation on here just because we don't have a copy of the cash flow statement here. Here are the ratios that we're going to cover for market value ratios. And the purpose of a market value ratio is so you can compare how expensive or how cheap one company is to another. So by itself, the price to earnings ratio or the market to book ratio doesn't have a lot of information. But when you use it to compare with other companies and how expensive or cheap they are, you're able to see, oh, this company is much more expensive, or this company is pretty cheap. Maybe it's a really good buy right now. The first ratio is the price to earnings ratio, and most people call that the PE ratio. If you were to go to some type of investment program, maybe like a TV channel like CNBC or some website, Market Watch, and they talk about recommendations on a stock, 9 times out of 10 they will mention PE ratio. It is probably the most common ratio to talk about when you're talking about how expensive a stock is or whether or not somebody's recommending a stock. They may either say that the PE ratio is really low, which makes it a really good buy right now, or they may say the PE ratio is really high just because the company has really high prospects for the future and they're likely to grow their earnings significantly. So like right now, I'm guessing if you looked up Zoom stock, their PE ratio is probably going to be very, very high. Probably higher than 100, I would guess. So let's take a look at an example how to calculate this. Basically, it's price per share, and we get that price per share from the balance sheet page. Normally it's a stock quote, but in the slides I put it on the balance sheet. So here's the price per share, 1032, and then we need to divide that by the earnings per share. Now, earnings per share may not always be available, so sometimes you have to calculate it, and you calculate it by taking net income and dividing it by the number of shares outstanding. Okay, and so here's shares outstanding right here, 1980 for 2009, and so that means we just need net income for 2009, and we get that obviously from the income statement. So if we go back to that, down here at the bottom is net income 2478, and so that allows us right here to go ahead and calculate the PE ratio. I'm sorry, calculate the earnings per share, 1.25. Then to calculate the PE ratio, we take the price per share and we divide it by earnings per share, which we just got. So 8.25. 8.25 is a pretty low price to earnings ratio. It seems like anything under 15 is fairly low. Anything over, I would say 30 is quite high for a PE ratio. And the reason a company might have a PE ratio over 30 is if people think the company's really going to grow earnings a lot in the future. So that means they think the earnings per share are going to grow very quickly. and because of that, they're willing to spend more for the stock. For companies whose earnings might be shrinking over time or not growing much at all, they'll typically have a low PE. And the other thing is with the PE ratio, usually you want to compare two stocks in the same industry. It's a little bit more, you get a better idea of which one's more or less expensive, because a lot of times entire industries will have similar PE ratios. Like the tech industry, is probably going to have a higher PE ratio than like the energy industry, and because of those growth rates. The other ratio we can do for market value is the market value of is the market to book ratio. And so that's just the market value of equity versus the book value of equity over here. And so the market value of equity, we've looked at that a couple times, and that is basically price per share multiplied by the number of shares outstanding. And for this company, it's price per share, we already got that, 10.32. And the number of shares outstanding is 1980. Okay, and we pulled that from in the previous example as well. So that gives us a market value of equity of 20,433. So now that's the top of the ratio. The bottom is going to be the book value of equity. And the book value of equity we can basically pull directly from the balance sheet, and that's 4271. And right down here, do you see where I'm highlighting with my pointer? 4271, that's the book value of equity. So that allows us then to calculate the market to book ratio of 4.78. Okay, so that's the market to book ratio, and that basically tells you how much is the company's market value right now compared to the original investments of equity that went into the business, right? So equity is kind of like the original investment that shareholders have made plus retained earnings. So it kind of gives you an idea of, again, similar to PE ratio, a tech company or a company that has lots of growth will have a high market to book ratio versus a company with a smaller market value but high book value. Book value will be something like a lot of assets, like a really old company that's been around a long time and has acquired a lot of assets. Oil companies, coal mine companies, that type of thing, they'll have low market to book ratios. And then we have profitability ratios. And the reason to have to use profitability ratios is to compare two companies to determine which one is more profitable, which one might be run better, which one has a better business model. Depending on the industry, you will see some companies typically have low return on assets, low return on equity. Give you an example, like grocery stores or retail companies in very competitive market segments. They'll have a relatively low return on assets and equity usually. But then if you look at a company like, like a Google or something very technology intensive, maybe a pharmaceutical company, they'll typically have a lot higher profitability because they'll usually have things like patents, proprietary technologies where they can charge more, and they're hard to replace by customers. Whereas retail stores, right, if you're going to buy a bag of chips, you can pretty much go to any grocery store, and so those grocery stores have to compete on price a lot. But if you're going to buy a certain technology product or a certain drug, usually there's much less choice and companies are able to charge a premium. So that shows up in these return on assets and return on equity. And so this is a big number for management because Wall Street or financial analysts often judge the company and how they're being managed by this return on equity. So for the first one, return on assets, we just take net income and we divide by total assets. That's pretty simple. Net income we get from the income statement, and total assets we get from the balance sheet. So here's net income again, down at the bottom of the income statement. And then assets we get at the bottom of the assets portion of the balance sheet. And so that's how we calculate return on assets. So how much profits are we getting out of all the assets the company owns? That's return on assets. And then return on equity, it's going to use the same net income down below here, but instead of dividing by assets, we're dividing by shareholders' equity. And shareholders' equity is going to be down here on the balance sheet at the very bottom of stockholders' shareholders' equity. So this tells you, return on equity does, it tells you how much profits a company is making based on how much money the shareholders have invested in the business, right? And the difference between return on assets and return on equity is how much debt the company took out. Let me show you a brief example of what I mean by that. Let's say we were to buy some investment property, and let's say the return on assets for the investment property is $10,000 per year in income divided by $100,000 in assets that we use to buy the property. So we pay $100,000 for a house, right? That's the assets side here. This is what the house is worth that we buy. Obviously, this is not the Bay Area. Let's say we're in, I don't know, we're in somewhere in North Dakota. And here is the net income that we get from owning that property, right? So for this property, the return on assets is 10%. Okay. Now let's take a look at the return on equity if we do something different. Let's say that we buy the investment property with a $90,000 loan. Okay. And this one up here, let's say it's all cash. Okay. And here we're doing it with a loan. So all cash means we put all our money in, $100,000, we get a 10% return. And so when a company takes on more debt, as long as they have profitable investments, they can really jack up the return for the shareholders. So let me give you an example here. Now, the return we get if we get a $90,000 loan is going to be less than $10,000 because now we have to make loan payments, right? So let's say the loan payments are equal to $5,000. Well, let's say $6,000. So that's going to be our net income right there. And what's our equity in this investment property? We got a $90,000 loan, so now our equity is only $10,000, right? So what's 10,000 minus 6,000 divided by 10,000? That's going to be 40%. So what is this saying here? If you buy an investment property and you use all of your own money, all cash, $100,000, your return on that $100,000 is 10%, right? But, and this is why a lot of companies take out debt, because if you take out a $90,000 loan, and let's just assume that you're paying a $6,000 mortgage payment or interest payments, now your investment in cash in the property is only $10,000, but now look at your return on investment for your equity. It's 40%. So what some investors might do is, instead of paying $100,000 and getting one property, they'll put $10,000 on each property and buy 10 properties. So by taking on debt, they can make a lot more investments and get a higher return on equity than if the shareholders didn't take out any debt. So that's how companies can affect this ROE very often, by taking on debt and amping up their profits. But it comes with a cost, right? And when you take on too much debt, the danger is, if something bad happens, you could go bankrupt if you can't make those loan payments. Like in this case, what happens if somebody stops paying rent for a couple of years? Well, you can't make those $6,000 loan payments. Now you might go into foreclosure. So that's the risk side of it. Yeah, these slides right here, this Word doc, is basically the notes in the PowerPoint slides. So it's this stuff right here. But it was hard for me to blow up the size to make it legible, so I copied and pasted it into this Word document. Okay, so let's talk about efficiency ratios. Efficiency ratios basically tell you how well the business is run. And I'll give you an example. The first ratio here is the asset turnover ratio. And the asset turnover ratio, which is sales divided by total assets, it tells you how much sales a company is generating for the amount of assets that they own. And so the higher the number, the better for this, because it means a company is doing a good job of not over investing in assets, that the assets that they do have produce. So higher asset turnover ratio, the better. And so it's sales divided by average total assets. Now let me comment on something on this formula. You notice how it says average total assets in the denominator? There is some variation in definitions for some of these ratios. The variation falls whether or not the textbook or the website that you may look up uses average total assets or just the latest total assets. And the reasoning is this. If you look at sales for a company, the sales are generated over the entire year, over 365 days. But when you look up assets, assets are only for one point in time on one particular day. So the thought process behind using average is that we look at the total assets at the beginning of the sales year and at the end of the sales year, and we take an average of the two. So that represents, on average, what assets were over the whole year when sales were generated. So it's trying to give you a more accurate idea of what assets were over the whole year, because sales happen over the whole year. And so that's the definition we're going to use. We're going to use average total assets. So that means when we calculate the asset turnover ratio over here, first we have to get sales, 61,101, and that's coming from the income statement. And that's coming right over here, 6101. Those are the latest sales numbers. And then we have to go to the balance sheet to get the assets. And so assets are right here. And so what we did is we took this year's assets of 26,500 and the previous year's assets, 27,561, and we averaged them. And that's what this is right here. So we took this year's and last year's assets and we took the average, right? Add them up, divide by 2. It's the same as multiplying by 1/2. That's our average assets over the course of the year when we had these sales. So this is the asset turnover number, 2.26. Same thing with the inventory turnover ratio right here. Okay, for that one, we're going to take cost of goods sold right here and divide it by average inventory over the year. And so cost of goods sold, we can pull that from the income statement. It's 50,144. And then inventory for this year was 867, and inventory for last year was 1180. Let's take the average of that. Okay, so that's the average inventory over the entire year. Divide that into cost of goods sold, and we get 48.99. So the higher the number, the better for inventory turnover ratio. Because what this means is that the company is going through its inventory very quickly. So if you go to a grocery store with a high turnover ratio, it means nothing has dust on the products. The boxes or whatever you're buying does not have dust on it because they're selling that inventory quickly. And this one means they're going through it about 49 times per year. That's a lot. Conversely, if you go to a store and there's a lot of dust on the product, that means they have very low turnover, very low inventory turnover ratio. And that's kind of inefficient, right? Because they've got too much inventory sitting around not being sold. In an ideal world, companies try to minimize their inventory to the point where, everybody can buy what they want, but as soon as something is sold, it can get replaced on the shelves fairly quickly. Because that, in the end, minimizes the upfront investment that a company has to make. Here, the receivables turnover. That's right over here on this slide. And this shows you how good a company is at collecting on their accounts receivable. So when a company sells something and they don't take cash, they might take an IOU. That IOU is called an accounts receivable. And so how good is a company at collecting on those accounts receivable? That's what this ratio tells you. And it's basically sales right here. This is the sales number we pulled from the income statement before, divided by the average accounts receivable. And so accounts receivable we would get from the balance sheet. So if we go back to the balance sheet, you can see right up here. Here it's called net receivables. That's the same thing as accounts receivable. And we've got 4731 and 7693. Okay, so that's receivables turnover. And what this number says, 9.84, the higher the number, the better, again, because it means that the company is collecting on its receivables quickly. But it is kind of hard to understand and conceptualize this number 9.84 in terms of what it really means. So a lot of companies will convert this number. This 9.84, we call that like the number of turns per year. But that's kind of hard to understand, right? So we can take this number and convert it to the number of days until payment. And that's called the average collection period. Here's the average collection period. And it's basically the receivables turnover that we just calculated divided into 365. I know it seems a little strange, but basically by taking the number of times we go through receivables in a year and taking that, dividing into 365, gives us the average number of days it takes to collect our bills, right? And in this case, that's 37.1 days. So that means when a company sells something on accounts receivable, they get cash for it after 37.1 days on average. And that's not too bad. A lot of times companies will sell product on the term that whoever they're selling it to pays them within 30 days, net 30. And sometimes companies would offer discounts if you pay like sooner, within a couple weeks. A lot of companies over the last number of years, now a lot of companies just basically accept credit card for everything, right? And companies love credit card, even though there's a transaction fee, maybe 2% or something like that. Excuse me. They get their cash like immediately, so that's much better for most companies compared to taking an accounts receivable. So even industrial companies working with other industrial companies, they love to get payment in credit cards because they get their money right away. So that's average collection period, and these are all efficiency ratios, and we can use them to compare how one company is doing compared to another. But when you do that, you do need to make sure that companies are in the same industry, because things like inventory turnover is going to be a lot different at a grocery store than it is a company that's selling something like jet plane parts or something like that. Okay, the next is leverage ratios. And these ratios basically tell us how much debt a company has, how much debt they have compared to their assets, how much debt they have compared to their value of their equity, or how much profits they have compared to the amount of interest they have to pay on their debt, or how much cash flow they have with respect to how much interest they have to pay on their debt. So this is all about their ability to pay off their debt. And so who would use this would be like banks, if they're looking at giving a loan to a company. They would run these ratios, and they're looking to make sure that all these ratios are kind of in a safe area. It's just like if a doctor's running tests on you, they're looking for certain values in a certain area that mean you're healthy. If something is going outside those values, then they might have to investigate it. In the medicine, it'd be different, but for a bank, it's likely that they wouldn't lend you the loan if you already have too much debt. And so this is how they look it up, and they'll have access to averages of debt ratios, debt to equity ratios for all the companies in their industry. So the first one, debt ratio, that's just going to be, we get that from the balance sheet. We got total liabilities right here, and here we have total assets, and we get 0.839. The higher this number is, the more debt a company has and the riskier they are. The debt to equity ratio, so this shows us how much total liabilities company has versus how much money shareholders have invested in the business historically. Here again, the higher this number, the more risky the company is. Because if something happens, like a pandemic or something like that, and the companies aren't making profits anymore, but they still have to pay interest expense or pay off loans, then they're going to be in trouble. And then we have the times interest earned, and this basically shows us a company's ability to make their interest expense payments. And what we're looking at here is EBIT. So do they make enough earnings before interest and tax to pay off their interest expense? You would definitely hope that this number is above 1. Excuse me, sorry. Because if it's below 1, they don't even make enough operating profits or EBIT to pay off their interest expense. And that one you see right here. EBIT we get from the income statement, and interest expense we also get from the income statement. You'll see right up here, here's the income statement, here's the EBIT right here, and then here's the interest expense. And you can see it's a lot bigger than the interest expense. So that means this company seems to be making plenty of money to pay off to help pay their loan payments. The next one is the cash coverage ratio. And basically cash coverage is taking into account EBIT, but it's also acknowledging that in EBIT we took out the cost of depreciation. But in the real cash world, we know that depreciation is not really a cash expense. It's only for our accounting statements. So in this cash coverage ratio, it adds back depreciation because that is cash that we can use to help pay off our loan payments. And in this case, depreciation we can get from the cash flow statement. And so right down here, we calculate it. Here's EBIT from the income statement. Here's depreciation from the cash flow statement, and then our interest expense again. Here, we got to make sure that this number is greater than 1. For the purposes of someone, if you're lending this company money, the higher the ratio, the better. The safer that the company is. Okay, liquidity ratios. Liquidity ratios look at the next year and the company's ability to pay off all their liabilities in the next year. So this is not just debt. The previous slide, we looked at debt, but this slide looks at short-term debt plus things like accounts payable. So does a company have enough assets to pay off their short-term liabilities that they owe? Things like short-term debt, accounts payable, that kind of thing. The first ratio looks at all current assets. So all current assets would be things like cash, marketable securities, accounts receivable, inventory, right? And so does the company have enough of that to pay off all their current liabilities? And so here again, you want a number that's greater than 1, because that means the company has enough money right now to pay off their liabilities over the next year. And for us, if we go ahead and calculate that, current assets divided by current liabilities, both of those come right from the balance sheet. We get 1.36. So that looks, it looks like they have enough. And for the purposes of a bank, the higher the number, the safer the company is, because then they'll have more money to pay their debts and they won't go less likely to go bankrupt. Now, the reason for this quick ratio over here, the quick ratio takes into account that sometimes companies carry inventory that might be worth very little money. Let me give you an example. Let's say if you owned a grocery store and you carried some English muffins from 5 years ago, and they went bad, but maybe you had so many of them, you didn't want to write it off as a complete loss because it would have made your net income look bad. So it just stayed there as inventory. Maybe it wasn't on the showroom floor, but it was in a back room somewhere. Companies do that because once they write off inventory as bad, it hurts their net income. So sometimes they just let it sit there and try to forget about it. And so that's why some banks realize that not all inventory can be converted into cash over the next year. So that's why we have this quick ratio. Quick ratio takes all the other current assets except inventory into account and kind of calculates the same thing again. So now we got cash from the balance sheet. We've got short-term investments or marketable securities from the balance sheet, and then we have accounts receivable. What is that divided by all the current liabilities? If the number's over 1.0, then the company seems to have enough money, short-term money, to pay off all their current liabilities this year. The next one is the cash ratio. And this solves another potential problem, because just like we said inventories can be bad, same thing can be said for accounts receivable. Some companies could be carrying accounts receivable that haven't been paid for over a year, and it's very likely that they may never get paid. Now, companies are supposed to write those off as a loss, which would hurt their net income. But sometimes companies don't like to do that because, again, they don't want to show a loss on negative income. And banks know this. So banks say, okay, I'm only going to look at your cash and your marketable securities. Let's compare that to current liabilities. And so this is a very stringent standard. And here we calculate it for this company, and they get 0.73, which is below 1. But again, the bank will have a database of other companies, and they can look this up, and they can decide whether or not they're willing to loan out money to a company with that cash ratio. All right, so that is the end of chapter 4. The quiz is going to be, it's largely based on the homework, right? So that's the most important thing. Understand how the homework is done. But don't just study the homework questions, because if I asked you what a money market security was, I might ask you what a capital market security is in another question. So I do vary the questions, but I follow the same format in terms of, you know, which terms do I use, which do I pull from, and how is the question worded. Calculation problems, I don't think we have a few with the ratios. I usually follow the same format, but I might ask for a different ratio, or I might put in different numbers to calculate. You don't have to worry about memorizing all the ratios. Like I said, I'm putting together a study guide, and that guide will have all the ratios in there, and that's it.
Would you be willing to show us the Yahoo Finance site for Disney?
Oh, yeah.
For the homework?
Yeah.
Because there is on the financial thing, it has a EBIT. It says EBITDA, if you know what that means. EBIT.
Yeah, that's a funny one. In finance lingo, it's called EBITDA.
Got it.
No, don't use EBITDA. Well, technically, EBITDA is basically EBIT plus depreciation. It's not the same as EBIT. I think it might be best if you just do it the way we did. I would ignore that EBITDA number, okay? Just for the purposes of homework, so we're all going over the same using the same numbers and stuff. But EBITDA is definitely used a lot in mergers and acquisitions. So an easy way to do this is whatever the company is you're looking for. Let's say it's Disney, Yahoo, okay? And then usually the first thing that comes up on your search is the right site. So here's the stock price right here. That's something you often have to have. And then if you go to this link right here, statistics, here's the shares outstanding right here. Okay. And then the other things you need will be under financials right here. So if you click on financials, I gotta say this Yahoo Finance site is so busy that my computer almost starts slowing down, and I might have to look at a different site here. And now look at, here's the, you can choose the income statement, the balance sheet, or the cash flow statement. And then you can use annual or quarterly. So we're going to use annual. And then under the income statement, here's revenue, cost of revenue, which is the same as cost of goods sold. And then the different operating expenses, you kind of have to hit that little triangle and open that up. Here's SG&A. Now, in terms of EBIT, let's use this number right here, because that's the earnings number before they take out interest expenses and income taxes, okay? That's basically what we want. We want the earnings number before interest and income taxes are taken out. And on the way they portray this, that would be this operating income, okay? So please use that number. And for the homework question, it would be this one right here. So that's their EBIT for the year ended 2019. Here's interest expense, right? Yeah, see, the EBITDA is much bigger.
So where do I find the depreciation to add it up to EBIT, or could I just use EBITDA? Because I think
let's use depreciation from the cash flow statement. That's what we did before. So here's the cash flow statement. Then you have to hit this little caret or triangle and open up cash flow from operating activities. And so this is the depreciation number you'll use right here.
Got it, thanks.
And then for the balance sheet over here, again, you kind of have to hit these little triangles to open up the accounts to see what's in them. And so like here's receivables for ending 2019. Here's inventory. And down here, let's see, down here's liabilities, current liabilities. Here's accounts payable. So yeah, the kind of tricky thing with these is you kind of have to hit these little arrows to open up those accounts into the sub accounts so you can see what the specific values are.